Hello, everyone. Welcome to this webinar, wherein we will discuss Search Capital's investment framework and how we invest in resilience plus non-linearity. Firstly, a quick disclaimer. Search Capital is a brand name used by me, Ankush Agrawal. I am a SEBI registered individual research analyst. The securities quoted are for illustration only and are not recommendatory. Some of the case studies that we'll discuss during this webinar are not recommendation, and I might have personal investments in those, some of those investments. You can find more disclosures at our website. Firstly, a quick introduction about me. So I'm a chartered accountant by qualification. I've been investing in the markets for last 10 years, including a couple of years of professional experience at some research and fund management firms like Mahindra Advisory Services and Stallion Asset, post which I started Search Capital in 2022. The flow of the webinar would be as follows. So firstly, I'll highlight the difference between resilient and non-linear business, how they differ as stocks, and the pros and cons of investing in each of them. Post which, we'll talk about how we combine resilient and non-linear investments to create a portfolio, and some of the other aspects of stock selection, conviction rating, risk management, and profit booking. Firstly, on resilient. So resilient business typically are those businesses wherein that can grow uninterrupted for a long period of time. These are businesses wherein the volatility of growth is low, and the probability of them reporting sustained degrowth is very low. So these are typically businesses driven by consumption or recurring sales. So most of the B2C businesses are resilient, but some of the B2B businesses are also resilient. On the other hand, non-linear businesses are those wherein the growth happens in short bouts. So there could be a couple of years of strong growth followed by a couple of years of degrowth. And so the growth volatility is quite significant in these businesses. The reason why this volatility is important because the price trend of a stock is an outcome of its earnings trend and its valuation trend. And valuation as a factor is highly volatile. It is determined by market and is highly sensitive to near-term earnings growth. So if a business has volatile earnings, that would mean that its valuation will also be volatile. And thus, a combination of volatile earnings and volatile valuation results a highly volatile price trend. So this diagrams quite reflect what I'm trying to explain. So a resilient business, typically the earnings are relatively stable. So for example, in an upcycle, a resilient business might be growing at 25-30%. But in a down cycle as well, the growth might come down to say 5-10%. Right? The probability of them degrowing is very low, which is why the valuations are resilient, and thus the overall stock price is also resilient. Which is why in most cases, these stocks goes through relatively more about time consolidation because earnings growth is in most cases positive, so that keeps backfilling into the valuations. Whereas in case of non-linear trends, so during an upcycle, these companies might start growing at 30-40%. Margins will also expand, and thus the valuation will also expand substantially. But when the down cycle comes, the growth goes from 30-40% all the way down to even negative, right? And because of this material change in growth rate, the valuations also takes a big hit, and thus the overall stock price is quite volatile. The reason why this is important is because it is relatively difficult to make money in volatile trends. There are a couple of reasons for it. Firstly, volatile trends, it is very difficult to hold across cycles because when the down cycle comes, the drawdown is quite sharp, and it is very difficult for a new upcycle to start in a near term, right? Secondly, even if someone is able to hold through a down cycle, the overall returns that you would end up getting reduces substantially because the down cycle is relatively longer in the stocks. And so the only way to make strong returns from non-linear trends that they have to offer is to get your entry and exit both right, which on paper is relatively easier said than done, but we know that recurringly getting both entry and exit right is very difficult. This challenges of non-linear trends is something that I have personally experienced. So early on, I was very focused on non-linear and optionality driven trends, and I had a portfolio that was fully based out of these kind of opportunities. But over time, I realized that a portfolio driven fully by this kind of opportunities not delivering the kind of upside that is needed to compensate for the high volatility and risk that you're taking both at an individual stock level and at a portfolio level. The reasons are threefold. First, even if you get a bet right and you make a lot of returns, the challenges that happen is all those are paper returns, right? So eventually, when the down cycle comes, you end up losing a lot of returns. So your end-to-end realized returns are relatively low. Secondly, in bets that don't work, from the get-go, your downside is relatively large, and overall success ratio in these kind of opportunities is relatively low. So at an overall level, your returns are not that great that at an individual stock level, that nonlinear trends might show that they can deliver. So having said that, I'm not saying that nonlinear businesses are not worth it. I think they can deliver very strong returns if played right. But the point that I'm trying to make is that like how trading is very lucrative, but is still a relatively harder and relatively lower probability way to do well in the markets in the long run. Similarly, in investing, an approach focused on resilient business is much easier and much higher probability way to sustain in the market in the long run versus an investing approach focused purely on non-resilient businesses. So in Surge, what we do is we combine resilient and non-linearity in such a way wherein we have a strong base of resilient businesses, and then we have a small portion of non-linear opportunities built on top of that. So that provides a great balance of risk reward and sustained long-term compounding for a portfolio level. So typically we like to have 75-80% of a portfolio within resilient business and another 25-30% in non-linear businesses. So this table provides some more clarity in how we differentiate between each of these buckets. So out of 20 stocks that we try to recommend, about 13 to 40 stocks is what we want on the resilient side. Our approach on the resilient side is much more accommodative, which means that we are ready to give a stock some room to perform, right? We are ready to hold through time consolidation, and we like to book profits gradually over here. Our expectations over here are to have above average compounding. We typically look for businesses that can deliver at least 25-30% earnings growth and valuation re-rating in most cases subject to growth. So if a company is delivering like 40-50% growth, then the valuation re-rating, even if it's not there, then it's still fine. Our horizon here is at least 3 years to begin with, and we would like to see much beyond that. The higher, the better. Based on our past experience, the success rate in this kind of opportunity is relatively high. And because of all these reasons, we prefer to have concentrated investments in this bucket. On the non-linear side, an ideal outcome is to have 6-7 active bets. Our approach here is quite sharp. So we would want to see our thesis play out immediately. Even if for 1-2 quarters we don't see our thesis play out, then in most cases we would like to take an exit. Our returns expectation over here is to have opportunities that at least deliver 1 to 2x return in the next 1 to 2 years. If that kind of growth or return is not expected, then we don't believe that the risk in this kind of opportunity is worth it. We would be better off investing that capital on the resilient side. Our investment horizon is typically shorter at about 2 years over here because typically the growth cycle in this kind of businesses never lasts beyond 2 to 3 years. Based on our past experience, the success rate is relatively low at about 50-50, but given the kind of upside that this business can deliver, even in the longer than half of the bets work, then that's a very good outcome. And because of this, above all reasons, we prefer diversified approach on this bucket. Now coming to our stock selection framework. So I personally believe that earnings growth is the holy grail, is the nearest holy grail that you can find in investing. If a business sustains strong earnings growth over longer run, then the stock trend would most likely do well, unless you end up buying it at a very out of the whack valuation. So earnings is where 90% of our efforts goes into figuring out the kind of earnings growth that a business can deliver going ahead. And that is where our starting point is in terms of our research and stock selection. Based on my own past experience and researching some of the past big winners, I've seen that there are certain qualitative attributes that are present in most winners in terms of them driving the earnings growth for a business. So in our research process, we try to identify presence of one or more of these attributes and try to evaluate them. The more number of attributes that are there, the higher the probability of growth and higher the quantum of growth. So these 6 attributes that we look for are first, the strong business model, innovation pivots, change and external trend, optionalities, leadership and edge, and stellar management execution. Now I'll explain each of this attribute with some past case study and some recent example. Again, a disclaimer over here. I am personally invested and most of the recent examples that I'll talk about, and most of them are also active recommendation in Surge's research service. So firstly, strong business model. Inherently, there are certain businesses or companies wherein the whole differentiator is the business model itself. That is, the business model itself is such that ensures that the company can grow at strong growth rates for very long. These businesses are typically differentiated, value add, and captures the most profitable and value added segment within an industry. A good past example is that of Bajaj Finance. So Bajaj Finance within lending followed a very differentiated business model, wherein they first acquire customers through a low ticket size, low tenure, and high RR product like consumer durable loans. Then they understand the consumer's credit profile and then cross-sell them more products. So essentially, Bajaj created a flywheel wherein they can keep acquiring customer, keep understanding their credit, refine their customer credit profile, and keep cross-selling them more products. As a result, they continue to expand in more and more product categories, and that's how they have grown so well in the last 2 decades. Another good recent example is that of Zaggle. So if we look globally, some of the most successful businesses are those wherein they don't necessarily monetize the users themselves, but instead tries to monetize the users' activity through a third party, right? Most of the social media platforms, YouTube, Google of the world are built on the same thesis. Zaggle, we see something similar kind of approach over here. So Zaggle is a fintech player that provides corporates with expense management solutions, wherein the software is tightly linked with the payment instrument that Zaggle's issue through its financial partners. Here, Zaggle does not charge its customers, which are the corporates, big time. So they charge a very small software fee. For Zaggle, the biggest monetization comes from the banks who share a part of their transaction revenue for bringing the spends that corporates do on the financial instruments that Zaggle issues to these corporates. So essentially, Zaggle, we see similar thing playing out wherein a corporate doesn't have to pay much to Zaggle, but they get a lot of value, which then Zaggle uses and monetizes through its partner banks. And increasingly, Zaggle is adding more and more services, trying to capture more and more expense flow of its customers to increase the kind of monetization that can do with the partner banks. So like recently, they've also started offering Forex service and travel management services as well. Innovation pivot. So businesses that not only innovate in the core businesses, but also keep pivoting to adjacent businesses typically create the longest growth trends. And these companies typically get the highest valuation multiples in the market. Reason being that, so there's this concept of S curve in business economics, with the S letter defines the growth cycle of a business. So it starts with infancy, then you have a growth phase, and then you have maturity. Essentially, in a company that is innovating and pivoting, they are adding one S curve on top of another S curve, and thus company at an overall level can continue to grow for a long period of time before reaching maturity. A good past example of this is something like Astral, which not only innovated in the core pipe business, but they also venture into adjacent businesses like adhesives, water tanks, and other building materials company, which is why they've done so well and they continue to grow at healthy rates. And one of the reasons why they trade at such high valuation multiples. Another good recent example is something like Varun Beverages, which started with certain states in India, expanded to more states in India, then ventured into foreign markets, and also during this phase, expanded the product portfolio from just carbonated beverage to mineral water to juices, and recently energy drinks as well. A recent good example is that of Unasa Consumer, formerly known as Mamaearth. So if you look at this company, in just 5 years from no revenue, they've grown to become a 2,000 crore revenue company. The entire playbook that Mamaearth is relying on is an innovation book wherein they are innovating hundreds of new products, right? Most of these products will end up becoming fat, but there are certain products that will stick with the customers and would become hero products, wherein Mamaearth will not only create a category, but they would have the first mover advantage and the leadership in those products, right? Mamaearth has adopted this innovation playbook on a large scale and have expanded the portfolio starting from just baby care to capture a much larger BPC category. Now they have 6 brands. Most recently, they have also entered into soaps and color cosmetics. And this innovation is what is leading to such high growth for them. Because if they would have come out with traditional products, they would have to compete with traditional FMCG players, wherein there was no way that they can compete with them. The only reason they are able to grow is because they're offering something new to customers, and that's how they're able to capture wallet share and mind share of customers. So the entire business is built on innovation as a strategy. Third is change and external trends. So a lot of time what happens is there's an external tailwind that is driving most of the growth of a business. In some cases, there is also an internal change that can lead to growth. Businesses driven by this attribute create some of the biggest long-term winners, primarily because change typically leads a non-growing business to a growth business. And that is why not only you get earnings growth, but a substantial valuation perception change as well. A great classic example of this is Avanti Feeds. So Avanti has been one of the biggest wealth creating stories in India. But before 2009, 2010, this company was not growing at all. But in 2009, government came with an allowed cultivation of white streams. And that is when the industry started growing at 20% CAGR. And on the back of that external tailwind is how Avanti grew at 40% CAGR. And when in 2018-19, when the industry stopped growing, even Avanti Feeds stopped growing. A good recent example is also something like Dixon, which is growing on the back of the PLI scheme. So that's another external trend. A recent good example of an internal change is Dollar Industries. So in the economy and mass market underwear segments, the industry is quite competitive and highly unorganized. These businesses typically historically have grown about, say, 10% or something. And the reason why this is because these companies work on a wholesale distribution model, wherein there are a lot of challenges like working capital issues, price cutting at the distributor level, and these in a wholesale distribution model, they don't have any visibility on the retailer end, and thus they're not able to drive demand on the retailer end to an extent. Dollar recently through their Lakshya project have moved to a direct distribution model, which is similar to what Page Industries had pioneered, wherein they faced a lot of these issues, and on the back of that, a Dollar for last many quarters has been growing much ahead of its peers. Historically, Dollar has not been a leading growth company, but now it is growing much ahead of its peers. Optionalities. So optionalities are basically certain subtle or smaller initiatives that the company is working on, which currently are visible, but market is not discounting them materially because they don't know how to discount them, or there's lack of visibility on how that optionality will play out. But in a lot of cases, if optionality plays out, that could lead to material change in the growth of a company. And we have seen that optionalities sometimes create some of the best nonlinear trends. So a great classic example of this is Reliance Industries. So Reliance had been working on Jio since 2011. 2016-17, when Jio was launched, Reliance's market cap was just around 40 billion. And in just 3 years, Jio itself was valued at 50 billion. So Jio, as an optionality itself, created more market cap than the market of the company that was there before Jio was launched. And mind you, Reliance is the largest listed company, most well-tracked company, but still market was not able to discount the optionality of Jio that was being built for last 6-7 years. A good ongoing example is that of Ethos. So Ethos is a luxury watch retailer. So this company has a lot of optionalities going for it, some of which have materialized as well. So along with trying to retail watches, they are also looking to venture into additional luxury businesses of, say, luxury luggage with removal, luxury jewelry with Messica. And then one of the big optionality in the core business is the custom duty reduction, which has already played out, but still not well discounted by the market. So currently, Switch watches imported in India attract 23% custom duty, but on the back of the recent FTA with Switzerland, the duty is going to reduce to 0% over the next 7 years. In our understanding, this duty reduction is going to increase Ethos's gross margin 1% every year. This 1% improvement is material given that Ethos is a retailer and thus it operates at a PBT margin of just about 10%. So 1% improvement every year is quite a material change, which is not yet discounted, but it's a big option that has played out and will reflect in company's growth in the coming years. Leadership and edge. So if a company has a leadership, then it puts it in an advantageous position to grow much ahead of industry. In a lot of cases, a company might not be leader, but they would have formed an edge, which is allowing them to grow ahead of the market, and eventually they will end up becoming a leader. CDSL is a good past example over here, when CDSL was the second player after NSTL, but CDSL had one edge for it, wherein CDSL had tied up with most of the discount brokers. So eventually, as discount brokers started gaining market share, CDSL's incremental market share went up as high as 70-80%, and eventually it ended up becoming a leader. A good recent example is that of APL Apollo. So APL Apollo is a clear leader in the structured steel tubes business. It has more than 50% market share. The edge that this company has is because of its scale, it is able to procure raw material at a certain lower cost. So this company consumes about 10% of India's HRC production and about 2% of India's steel production. Given the industry that it works in, wherein they're basically converters of a commodity steel into some products, this business is even a slightly lower raw material pricing is a huge edge. And APL Apollo has used that edge not to have better margins for itself, but it has used that extra margins to further discount its products and get more economics of scale and further double down on its edge by gaining more market share. Another thing that it has been doing is innovating more value-added products, and that is further adding an edge that will play out in the coming years for this company. Finally, stellar management execution. So a lot of times what happens is it's the execution of a management that drives growth in, say, even a poor business or even in a business that is at a place of weakness. So a great past, current, and probable future case study would be Safari Industries. So Mr. Sudhir Jatia, after leaving VIP, purchased Safari, which was an unknown brand. And in the world, nowhere has happened that in an oligopoly industry, a new player has come and gained market share. But Sudhir Jatia, it was Sudhir Jatia's execution that Safari went from nowhere to the third largest luggage manufacturer in India and the largest in the value segment. Now, even after scaling the business, Safari was still at a disadvantageous position when it came to profitability and working capital efficiencies. But in last few years, Mr. Jatia has executed there as well, wherein Safari's margins and working capital efficiency is now better than VIP. And as a result, Safari's market cap is now much higher than VIP. So inherently, what Mr. Jatia's execution has done is taken Safari from position of weakness to a position of advantage, firstly on scale and then of profitability and working capital efficiency. Most recently, he has launched a new brand called Urban Jungle to compete with Samsonite's American Tourister. So here again, he's starting from a position of weakness because Safari has historically focused on the value segment and they don't have a premium offering till now. So in our understanding, if he executes well, this could also become a great case study for future management execution. So that covers the attributes. One other important aspect that I want to add over here is that over time with experience, we continue to refine each of these attributes, wherein we are figuring out more and more as to what works and what does not. So for example, within stellar management execution, we figured out that the best risk reward is available when you bet a management that is taking one of the biggest project. The reason why it works is because in such kind of massive project, market, rather than looking at upside, discounts the risk much better. And so if the management executes on the big project, not only you get a big earnings growth, but you also get re-rating because earlier the market was counting the risk and not the upside. Similarly, on the strong business model side, we have seen that some of the best value-added businesses are those that work on low volume, high value, and high customization kind of businesses. This is something that I learned with my investment in Suva Life Sciences, and I was able to replicate the same understanding within auto ancillaries to figure out RACL GateTech as a business. Similarly, we also figured out what clicks in a platform business in terms of profitability. So we have written about all these frameworks in our knowledge base. Anyone can just go out and read about them. So essentially, we're trying over time with experience, we're building a library of sorts as to what works and what does not. And that will help over time improve our investment outcome substantially. So the second aspect in our investment framework is about conviction rating. So along with providing buy, sell, and hold rating, we also provide something called as conviction rating, which defines relative positioning of a stock in terms of risk reward on a scale of 1 to 5 stars. Right. So this conviction rating is based out on a 4-factor framework, which wherein the 4 factors are price trend, earnings growth, valuation, and sentiments. So the way this framework works is we look at the relative positioning of each stock on all these 4 factors across 3 different conditions, which are bad, good, and great. So in case of price trend, if a stock is making new lows, that's bad. If it is just broken after consolidation, that's good. And if it has been trending for a long period of time, that's great. On earnings growth, if the growth is negative, that's bad. If it's positive, it's good. If the growth has accelerated in the recent past and is at a highest it has ever been, then that's great. On valuation, if the valuation is depressed or is lower than its average, that's bad. If the valuation is trading at its normal average level, that's normal. And if the valuations have re-rated in the recent times and trading at the highest it has ever been, that's great. On fraud, if a company has a negative sentiment or known, say, corporate governance issues, etc., that's bad. If a company is less known, less tried, then that's good. And if a company is such that it is very well tracked, everybody follows it, and it has kind of a quality tag attached to it, then that's great. So an ideal setup wherein we will end up giving a highest conviction rating would be one wherein all the 4 factors of price, earnings, valuation, fraud are good, including valuation being bagged as well. Reason being that if a stock's price has just broken out of a consolidation of a years, that kind of signal that something has changed. And since it has not been going higher for some time, then if the positive change plays out, then there's a lot of room for the price to move higher. Similarly, on earnings, if the earnings is not positive, then you're not waiting for a turnaround. But at the same time, since it is not accelerated, there's room for acceleration to happen, which if happens in a situation wherein the valuation either depressed or are at absolute level, then there's a lot of room for valuation to expand. And if all of this plays out in a company which is less tracked and less known, then when this discovery happens, you will get the discounting much quicker. So inherently, all these factors have an interplay between each one of them and are playing into each other. The opposite end of this is a setup wherein everything is great, right? The price has been going high for a long period of time. The earnings growth, it's the highest ever. Valuations have expanded and at the highest level, and everybody likes the stock. It's the talk of the town. In such situation, the risk reward is very unfavorable because everything that can go right has gone right. So from here on, if anything negative happens, then you're looking at a much larger drawdown. So if the earnings started to the growth started to reduce or there's some negative sentiment even, right? So these are the situations that we avoid. A similar other option would be one wherein a setup has all the bad factors, right? So those would be typically your turnarounds, wherein obviously the upside is quite huge, but turnaround seldom works, so the probability is very low, which is why we also avoid those kind of opportunities. So the four-factor framework not only helps us determine conviction rating, but it also helps us sort of avoid certain situations altogether. The next part that I want to talk about is profit booking and capital rotation. So conviction rating is something that is dynamic. So at every certain individual interval, like say quarter end or when there's major development, we try to reassess the conviction rating based on the framework that we just discussed. And based on the changes in conviction rating, we'll take our action in terms of whether we want to add, whether we want to book profits, or whether we want to exit. So an ideal trend for us would be one wherein we are able to build high conviction rating at an early stage. Reason being that if the prices just started moving, if the earnings can accelerate, if the valuation is low and nobody knows about the company, then the risk reward is obviously great and you should have a lot more capital into that opportunity. And then over time, based on how the conviction rating changes, we would like to book profit. So for example, if when we entered into a business, there was scope for valuation rating, but over time the valuation has re-rated and there's no longer scope. So we need to account for that in terms of a risk reward and thus book profits. There are material benefits of doing this profit booking because first, it ensures that at any given moment, you have a right exposure to a stock. This is important because you don't want to end up in a situation wherein at the top of a stock's price, you have the highest exposure because selling is inherently one of the difficult aspect of investing. And even if you have even if you have 10 good sales, out of that only 2 or 3 would be would be such that wherein you would have exited at the top. In most cases, you will end up exiting 25-30% lower after the top has been made, right? So you don't want to end up in a situation where you have the highest exposure at when the top and drawdown comes. Second thing that profit booking allows is allows for rotation of capital. So there are very few companies that can continue to grow for a very extended period of time. And even those that do, the pace of growth eventually ends up reducing, right? So for a portfolio to continue to compound at high rates, it is important that we continue to incorporate fresh new ideas and that have much better risk reward versus the past winners. So profit booking inherently forces you to that because it clears up capital for you. And lastly, what profit booking helps in a subtle ways is to hold on to our winners. So if you ask any successful investors, they'll tell you that the biggest money is made holding a stock across cycles. But it is also one of the most difficult things to do, primarily because when the consolidation or correction or drawdown comes, it is very difficult to figure out when the new upcycle will come, right? But if you have already booked some profits and you have a lower exposure in a stock, then that provides a lot of comfort in holding onto a stock because then you're not overly worried of the drawdown or the time consolidation that would happen. Now, one would say that, profit booking will reduce the returns that you'll get. So consider this example, right? If a stock, say, ends up going 300% from where you buy it. So if you don't book any profit, then say you get 300% gain, right? But in a profit booking environment, assume that at 100% gain, you book 25% of your position, and 200% you booked another 25%, and at 300% gain, you book the remaining 50%. In this scenario, also, you will get 225% gain, which is about 70-75% of the gain that you would have gotten if you have not booked profits. But on top of that, you also get a strong risk management, wherein if at any point, if you would have gone wrong in terms of your future expectation of the business, you would not be having a very large exposure because you have already booked some profits. And thirdly, since if you book profits, you also get some capital that you will reinvest in new opportunities. There would be more upside that will come over and above the 225% gain. So it could very well be a situation wherein the overall upside from an existing position and new position that you invested on based on the capital released after profit booking would end up delivering much higher return than 300% gain that you will have, right? So this profit booking approach is something that we follow because inherently we believe that it provides a very good risk management frameworks and allow us to consistently compound at a higher rates in the portfolio. So that was broadly on how we invest. Surge is basically an extension of my own investing. So whatever I do full-time as an investor, all the actionable outcomes, whether in form of stock recommendation or learnings are shared in Search. I am absolutely invested 100% with all the ideas that are recommended in Search, and it is the only thing that I do within Search in the markets. I don't do anything other than what is there in Search. And I look at Search as a win-win situation for me and members. So for me, apart from some monetary gains, it's a platform for my own learnings. It keeps me on my toes. Most importantly, it reduces the risk of me blowing up substantially because uh, now there's a realization that my uh, actions have uh, will have impact not just on my portfolio but on a lot of other people as well. So there's a lot of discipline and thought that goes behind making a decision, which wouldn't have happened if I would investing for my own. And another important aspect is it forces me to write. Uh, Writing eventually brings a lot of clarity in your thoughts. With Search, since I have to provide research and updates, it inherently forces me to write, and that eventually brings out a lot more clarity otherwise. For members, you get access to the stocks that I'm investing in, which is a combination of resilient and non-linear businesses. These ideas are supported by one of the most comprehensive research reports that you'll get that will not only help you build conviction, but also help you sustain. On top of that, there are regular and transparent communication, including quarterly con call for members and a growing knowledge base wherein some of the key learnings that I gather during my own investing is something that I share in form of knowledge base posts for members. So that was all that I wanted to discuss today. Thank you so much for listening. Also, I'll highly recommend you to visit our website. We have a lot of free resources like shared research reports and knowledge base that is available for everyone to read. Also, you can sign up on our website to get access to one of our recent stock recommendation as well. So thank you so much for listening. Have a great day.